Well, it is monthly Q&A time here again on the channel. I put up a community post here on YouTube a couple of days ago to collect your questions for this video, and we've got lots of really good questions coming through, so thank you very much to everyone who did ask a question. If you're interested in asking a question to potentially get answered in a future Q&A video, just turn your notifications on for the Investing with Tom channel. That way you should be notified every time I upload a video and every time I put up a new community post. And those community posts are always where I collect the questions for these monthly Q&As. So as usual, just going to roll the camera for a little while and see how many questions we can get through. So if you enjoy the video, be sure to subscribe if you haven't already. But without further ado, let's get straight into some of your questions. Okay, so first question here is from Diraj. When you look at a balance sheet and earnings report, what are some immediate green and red flags you look for? Yeah, I don't know that there's any immediate, green is maybe a little trickier, but red flags are usually more straightforward. I don't know that there's anything that like springs right to the top of my head for every single business other than like you have a lot of upcoming debt obligations and I don't think you're going to be able to meet them and you're going to have to file for bankruptcy. I'm yet to stumble across many earnings reports of companies that I'm interested in where that's the case, but that would be a very immediate red flag. Generally, when I'm getting, quarterly or half-yearly updates from companies that I follow or that I'm invested in, I'm really just trying to match my investment thesis against the results of the business. So I guess green or red flags is really just how much it might vary from my expectations versus, what they actually report. Red flag is obviously if they do a little worse than I had expected. Green flag if they do a little better. But generally, I'm just trying to put these things in the context of the business and, my thoughts on where that business is going. So it's hard to give exact, green or red flags outside of that. But good question. Next one is from Kalichiwama, who is the next guest on the podcast. I've got a few kind of guests in the works. I don't want to give away too much, but I am hoping to interview the author of a book that's sitting on my bookshelf that I picked up last year that taught me a lot about the banking system, or at least banking business models. So for anyone that's been following along with the channel for a little while now, that will hopefully give you a couple of clues. But I'm always hesitant to put those sorts of things out there before we've actually recorded the podcast, just in case, there's scheduling issues or we don't kind of get across the line and record a podcast for whatever reason. But that's what I'm working on. But as always, please let me know down in the comments below if there's any guests you think would be really good to get on the podcast, and check out the Investing with Tom podcast. It's a separate YouTube channel. It's available on Spotify and iTunes and so on as well, if you're not already following along with the show. But always interested in guest ideas. No promises that I can get every suggested guest on the podcast, but I'll do my best if I find them interesting. So good question, Kalichi. Next question here is from Akshay. Hopefully I'm not butchering your name there. What's the most amazing business you have ever laid your eyes on? If you have to name one or two businesses on top of your watch list, which would it be and why? Thank you for posting amazing videos. Thank you for the very kind feedback. Most amazing business I have ever laid eyes on. I guess just going back to like fundamentally what a good business is, Buffett gives it a very straightforward kind of definition. One, it earns a high return on capital, and two, it earns a high return on capital and grows would be an exceptional business. So probably one I've come to appreciate much more. And again, it's easy to say when you have like a 20-30 year track record of like ridiculously good returns, would be something like Apple. Obviously Buffett bought a lot of Apple in 2016. That was kind of before I was getting really serious about my own value investing, so I've sort of missed that boat. If it does get cheap again, I would love to buy something like Apple. But that's an incredible business. You've got a super powerful brand where Apple can charge, a big premium over and above other cell phone providers, which is really a big chunk of Apple's business. But increasingly, they've got a software business which has very, very high margins. It's helped Apple to kind of improve their margins over time. They've got very good capital allocation with Tim Cook doing a lot of share repurchases. Kind of less so now, but when they had that big pile of cash 5 or 6 years ago and plowed that into share repurchases at like 10 or 12 times earnings, that was exceptionally good for shareholders. And they've, outside of the buybacks and so on, been able to retain a lot of capital to continue to grow the business. So yeah, it's kind of got the best of all worlds in that respect. So that's a business that is probably the best I've ever laid eyes on. That's probably not a surprise to a lot of people. I think everyone at this point kind of appreciates that Apple is an incredible business, and that's the reason why it fetches the the price and the market cap that it does today. And on the second party question, if I had to name one or two of those really incredible businesses that's on kind of the top of my watch list, I would love to buy something like Apple if it got cheap again. Not investment advice for you to do the same or what have you, but that would be fantastic. I would sleep exceptionally well at night. I do actually have quite a significant amount of sort of look-through exposure to Apple through Berkshire Hathaway in my portfolio, so that's probably worth noting. I'm not completely, unexposed to Apple as an investment, and a lot of you probably have it if you are in index funds and stuff because it's a huge chunk of the index. But something like Apple, Costco is another business I've got a lot of admiration for, again for quite similar reasons. It's got a good return on capital. It's really like a win-win-win business where it's good for customers, good for employees, good for investors. They've got high returns on capital, like I say, but they can also continue to reinvest and grow at those high rates as well. So there's maybe a couple of businesses for you to dig into if you haven't already. Okay, next question here from Luis. Have you ever done a payout ratio for stock buybacks rather than just dividends? I wonder why there isn't as much interest as to whether a buyback is sustainable based on current and expected earnings. And I'd be very interested to see if a company was at risk of ending buybacks at what would likely be the ideal time to do them. Yeah, I look at that all the time actually. I almost always look at a company's free cash flow, and I'm probably not specifically looking at what percentage of that goes to buybacks or what have you, but I'm just trying to figure out increasingly what is a company actually doing with that free cash flow, and buybacks oftentimes will come up with companies that I'm looking at. So yeah, it's definitely something I pay a lot of attention to. I've covered it in previous videos with Alibaba, for example. How much free cash flow are they generating? A big chunk of it at the moment is going towards share repurchases, so that can give you a bit of a feel for how sustainable that may or may not be. Another company that I've dug into a little bit recently is Charter Communications. They have retired an enormous amount of shares over the past 5 or 10 years at this point. But they've done it through kind of levering up the business and taking on some debt. Some of the railroad businesses have done the same thing. I think Starbucks has done the same thing. So, if you can make it work and you can get cheap debt and buy back a lot of stock, mathematically it can actually work out very well. But you're obviously adding some extra risk to your balance sheet and so on. And, you can't really do that indefinitely, get increasingly leveraged just to retire shares and so on. So it's a very good point you raise, and definitely something I pay attention to. Question here from Joey. Shareholder equity. Why should we care about it? I love buybacks, but I have been studying companies that wiped their equity base because of this, plus dividends. Does ROE, measuring returns against assets minus liabilities, suddenly mean nothing in measuring companies giving their cash flow to shareholders directly? Your Costco video helped me, but I still can't find a satisfying answer. Yeah, great question. I've covered this a couple of times on the channel, I think. Firstly, in terms of shareholders' equity more generally, and looking at sort of multiples of book value and so on, book value really is only relevant for certain types of companies. Obviously, everyone wants to earn a high return on capital and so on, but if you can't deploy incremental amounts of capital in the business, you just have to pay out everything as dividends or buybacks, then the return on equity is kind of irrelevant. Something like Buffett's Kraft Heinz investment is a good example of that, where they have a phenomenal return on tangible assets and return on equity and so on, but there's just no room for them to invest more equity at those high rates. So in that example, return on equity is kind of irrelevant, but with something like a bank or a real estate business or something that needs more kind of equity and assets to grow over time, book value and so on becomes very important. The point you raise about companies wiping out their equity through a lot of buybacks and dividends, I've stumbled across a few of those over time. McDonald's is one. Increasingly, Apple is having some weird numbers in their shareholders' equity. So for anyone that's unaware, basically, if a company buys back $1 of stock, that goes towards treasury stock on the kind of balance sheet for the company, and it reduces their equity. And if they have the same net income but lower balance sheet equity, it makes the return on equity look a little higher. So I do actually adjust for that when I look at some of these companies. It's a topic that's covered in Warren Buffett in the interpretation of financial statements. So if you basically just take the shareholders' equity and add back that treasury stock at cost item, and you compare that value to their net income and kind of calculate return on equity in that manner, that will get you a much more meaningful result. And that's an exercise I've actually gone through with the likes of McDonald's, where they have a negative shareholder equity. So it's increasingly one that can catch people out, because buybacks have become very, very common, and it's not unusual to see some like highly skewed equity numbers, just looking through basic websites or even directly at a company's shareholder equity without digging into the different components. Question here from Menash. When do you think Charlie Munger figured out that Alibaba was his worst investment? I'm assuming that should say before selling half or after selling half. Just specifically on the selling half thing, Munger hasn't confirmed this, but I think the general consensus is that that was sort of inverse tax loss harvesting. Munger, rather than selling his Alibaba stock at a loss, waiting 30 days and then repurchasing back in, which is what he would have to do to be able to kind of claim those tax losses. He instead doubled his position, waited 30 days, and then sold the original shares at a loss. It's kind of an inverse way of doing that. You continue to have the exposure to Alibaba shares over that 30-day period, and you actually have twice the exposure as opposed to having no exposure, which, Munger, thinking probabilistically, I think he would have rather had double the Alibaba exposure for a short period of time than had no Alibaba exposure for a short period of time. So I think that's the general consensus on why Munger might have sold half of his Alibaba stake after doubling it the previous quarter. When did he figure out that it was his worst investment? If he was looking to do some tax loss harvesting because it was down 50%, maybe it was well in his head by then. I don't quite know. There's still some pretty good arguments around Alibaba being quite a cheap stock, but again, not investment advice. Please do your own work on it. And we'll have to see how it plays out over a several year period, maybe 5 or 10 years from today. We'll have a much clearer picture of how well the Alibaba investment worked out. Next question here from QQQ. Do you cover stock-based compensation and stock dilution and debt on your stock analysis? Stock-based compensation, most definitely. Alibaba, which we've spoken about a couple times in this video, again is a good example of that. In the previous videos that I've done on Alibaba, you'll often hear me talk about free cash flow after stock-based compensation. So I sort of add that back, which reduces the overall free cash flow number for the business, but you're capturing quite an important factor that will impact your returns, which is if there's more shares outstanding over time because of stock-based compensation, that is a real cost to you as a shareholder. So that is most definitely something that I pay attention to. And on the debt side, absolutely as well. I think about it a little bit like buying a piece of real estate. If you buy a piece of real estate and it has no debt attached to it, you will generally have more equity than if you buy a piece of real estate that does have a lot of debt attached to it. And that's kind of the way that I think about, market cap versus enterprise value. So I certainly do pay attention to how much debt a business has, and I sort of adjust my, price that I would want to buy stock in that particular business at. I adjust that based on the amount of debt they have, for sure. Question here from Karen. When are you planning to fly to Oman for a fishing trip? I would absolutely love to fly to Oman for a fishing trip. I know a couple of other New Zealanders that have posted some great videos here on YouTube, going and like doing some top water fishing for yellowfin tuna and all that sort of thing. So that would be epic. Karen, if you can give me a date and something that might work, maybe we'll figure that out. But yeah, that would be the dream. Would love to do that. Question here from Jonas. Do you like serial acquirers as a business model for long-term investments? What are the major risks? Yeah, I actually have a couple of these in my portfolio, and they're certainly some of the bigger positions as well. You would call serial acquirers. So, companies that go into a given industry and just acquire more businesses in that industry over time, as opposed to growing organically. In terms of major risks, I think there's a couple of things, like just getting outside of your circle of competence, kind of similar to, an investor in stocks. In a way, an investor in stocks is a serial acquirer because we're acquiring stock all the time in lots of different businesses. And the place where we go wrong is basically we get outside our circle of competence, we're wrong about the future earnings of a given business, and we pay an inappropriate price. We pay too much for the company. All those exact same rules basically apply to serial acquirers in an industry. So if a business has an industry full of acquisition opportunities where the returns on capital are good, the prices are low, there's relatively little execution risk. Those are all things that I really start to like. But with a few exceptions, maybe Berkshire Hathaway is a pretty good exception. If a business starts to acquire other businesses in all sorts of random industries, that's generally not a great sign, but Berkshire is an obvious exception to that, but they're a pretty rare example. So assuming they tick some of those boxes of good returns on capital, cheap prices, long runway to keep reinvesting, all that good stuff, I certainly don't mind serial acquirers as potential investments. And just one last thing I'll add on that in terms of major risks. You do have to be a little cautious how serial acquirers sort of pay for the acquisitions that they do. It's really nice if a company just continues to generate tons of free cash flow, and they start to have this really high-class problem of having to figure out what they do with the cash. If they're using that cash to pay for acquisitions, that's obviously a much lower risk strategy than going out and borrowing a bunch of money and really levering up the company. The other thing you'll often see with serial acquirers, from time to time at least, is they will issue their own stock and kind of dilute existing shareholders to acquire other businesses. And again, in certain instances that has worked. Henry Singleton at Teledyne is a very good example of that, where he would issue stock in the public markets at, say, 20 times earnings and would go and buy private businesses at, say, 10 times earnings, and the earnings per share would increase even though there were more shares outstanding. So it can work, but you have to have very good management in place that truly understands capital allocation well. Okay, question here from Pat. In your investment career so far, would you have been better off buying an index like the S&P 500? Yeah, that's a very good question. I have tended to avoid actually answering this question on the channel before for a couple of reasons. One, I feel like the track record is far too short. And two, for the first reason, because the track record was short, I don't want people kind of thinking I'm some sort of super gifted investor or some terrible investor just because of where the track record sits over a relatively short period of time or anything like that. I don't want to kind of like mislead people in that way. But yeah, the short answer to your question, would you have been better off just buying an index like the S&P 500, is no, happily. The answer is no to that question. My stock portfolio is sort of split into a few different buckets. So we have retirement accounts in New Zealand, which for us are a pretty modest size now. We actually took that money out to use as a deposit towards our first home, which we just bought last year. But the money that has been kind of rebuilding that account, that's basically just an index fund. In New Zealand, we have very, relatively few options compared to some other countries in terms of how that money's invested. So it's just in more or less like a global index fund. Outside of that, we have personal investment accounts, and a chunk of that is in New Zealand exchange traded funds, and a chunk of that, which is now sort of most of the portfolio, is in value investing type stocks. I bought my first quote sort of value stock in late 2018. At that time, it was literally just a single stock. I had that sort of alongside my New Zealand ETF investments and so on. And it took me a good year and a half, maybe close to 2 years, to actually get to where I felt like I had a reasonable portfolio of sort of value stocks, more than 3 or 4 holdings, for example. And it's been probably less than 3 years since reaching that, point where I felt like I had at least 4 or 5 stocks, which is still very concentrated, but had some sort of value portfolio built up, and to where the money was actually getting, like the absolute size of the portfolio was getting to a reasonable point as well. So to be perfectly honest, it's a little bit of an arbitrary line in the sand that I've kind of drawn to calculate my performance from, feeling like I had some reasonable portfolio built up rather than just one stock. But if you measure from that point through to today, we have, modestly outperformed the S&P 500. It's not like 30% a year or anything spectacular that you kind of hope and dream of. But we have done a little better than the index, which is kind of nice to look at and nice to say. But I really just want to stress it as a very short-term track record, from that arbitrary line in the sand kind of point that I've drawn. We're probably talking 3 years or a little less than 3 years. And I run a very concentrated portfolio. So, if my top 1 or 2 stocks were to, get chopped down, say 30%, or even get cut in half, for example, I'd be very excited from a potential buying opportunity, but it would absolutely ruin the track record. And that's just the nature of a short track record and, a concentrated portfolio. So, happily the answer at the moment is we would not have been better off just buying an S&P 500 index fund, at least in that value basket. The New Zealand ETFs have actually lagged the S&P a little bit, but in that value basket, we're doing okay. So far, so good. There's definitely been some mistakes in the mix, but the big positions, kind of the big bets, we've been right on so far. So those are all the questions we have time for in this video. Thank you very much to everyone who did ask one. If you enjoyed the video and haven't subscribed already, please be sure to do so. And keep an eye out for next month's community post if you are interested in asking a question for next month's Q&A. But that's it from me for this one, and I'll see you on the next video. Cheers.